ดีค่ะก็ได้เวลาการนำเสนอข้อมูลของไตรมาส3ของบริษัท PSL Shipping จำกัดมหาชนนะคะ PSL หนังไตรมาส3โดยคุณคาริดฮาชิมกรรมการผู้จัดการบริษัทในเรื่องของภาพรวมของอุตสาหกรรมแล้วก็คุณกอตัมคูรานา CFO ของเราในเรื่องของตัวเลขผลการดำเนินงานแล้วก็คำถามคำตอบนะคะค่ะเชิญคุณคาริดค่ะ
สวัสดีครับ Good morning. We will do the presentation as usual in two halves. In the first half, we will talk about the industry structure, and in the second half, we will talk about the specifics of the company. So this slide sort of shows you the trend line, and you can see this quite clearly that if you look at this trend line, it shows you that the upward movement in the BDI is sustainable. But there is a big drop in this area, and I want to explain that to you. So if you look at this slide, this is for the Capesize ships, and this, the left-hand side shows you the rate structure for the Capesize. On the right-hand side is for the Handy and the Supra index. Okay. So now this line, the black line is the line of the Capesize, and you can see that on the 25th of January, the day that Vale had the mining disaster in southern Brazil, the Capes were earning an average of almost $13,300 per day per ship. And then, because of the Vale mining disaster removing about 25% of their exportable surplus, they normally export about 400 million tons per year. About 100 million tons comes from the southern mines. So once that southern mines got a supply of iron ore got removed, at the same time, Australia was hit by two cyclones. Starting on the 18th of April was the cyclone Veronica, followed by the second cyclone Wallace, which got over on the 16th of, Veronica started on 18th of March, and Wallace got over on the 16th of April. So during this period of time, even Australia was not able to export its normal way. So as a result, on the 2nd of April, the rate for the Capesizes came down to $3,460. So a big collapse in the market. Now, at the same time, if you look on the 3rd of June, you see that the rates have gone back up there, even though Vale had not yet got permission to start their southern mines. And the reason for that is shown over here. First of all, that the Capesize sector scrapped more ships in the first half of this year than they did in the whole of last year. So that's the first thing. They removed a lot of supply then. And second thing is that they started to slow down the ships. And slowing down the speed of ships by just 6% resulted in this market going up from 3,500 to 13,300 in the space of another 2 months' time. And now, if you look at this line, you see that now that the Australian mining disaster was sort of taken care of, the rates had gone up to the 25th of June to 18,639. At that date, the Brazilian judicial system allowed the major mine in Brazil to restart operations. Not all of them, but the major mine, which has about 30 million tons of capacity per annum. So out of the 130 million tons started at that point. And you can see that after that, the rates just went crazy and went up to the 3rd of September to $37,500 per day per ship. Now, as a result of that, what happened? Of course, no more ships were scrapped. Secondly, the ships that were there started to increase the speed to 11.4 knots. So the difference between 10.3 knots, which is what they did, they slowed down too. And then the 11.4 knots, it increased the supply by almost 10.8%. So you can see that just a small change in speed can make a big change in terms of the supply of ships. And as a result, of course, even though markets were strong in terms of demand, rates kept coming down. And you can see that the Cape rates are now down to about the $25,000 or $24,000 level. Now, in the meantime, if you look at what's happened to the Supramax, this is the blue line. And you can see the blue line. We also collapsed as per the normal Chinese New Year pattern, and then sort of recovered. And as the Capesize market recovered, we also recovered. And as the Capesize started falling, we are also falling. In the meantime, if you look at the little darker shaded line, which is the handy size line, it came down as usual in the Chinese New Year period and then started a slow recovery and then came up to a peak of about $10,000 a day and is now somewhere around the $8,000 a day mark. So again, we follow the sentiment of the cape size. So if the capes are going up, then even our rates start to go up. If the capes start to come down, even our numbers start to come down. So just keep in mind in this one that any change in the supply of ships can result in rates coming down or rates going up if the supply of ships increases. In this slide, we are showing you that the second half growth in cargoes is actually stronger than the first half, and it tells you that the trade war between US and China has had no real impact in terms of the cargo carrying or the cargo availability to be carried by ships. This slide shows you that the scrapping of ships follows and is an inverse reflection of the BDI. That means when the BDI is weak, as it was in Q1 2016, scrapping was pretty high, almost 15 million tons. And if you look the whole of 2016, you can see that as the BDI was the lowest in history, we also had almost 30 million tons of ships being scrapped. The next year, 2017, was a reasonably good year. By the end of the year, ships had become profitable, and therefore scrapping came down to half the level that was there in 2016. And in 2018, when most companies made profit in all 4 quarters, you can see scrapping came down to 1/3 of what it was in 2017. And this year, as you can see in Q4, with the rates having gone up, scrapping has almost come down to 0. So for Q3 and Q4, very low scrapping because of the rates having gone up. So the question is China's growth sustainable? And if you look at these numbers that we put up for you, all the numbers indicate to us that yes, it is sustainable. If you look at growth in seaborne dry bulk trade in millions of tons, just tons, then you can see that the total cargo growth has been in the magnitude of between 2 and 3% per annum growth. But if you see the same thing in billion ton miles, which is more relevant for us because that shows you how the ship's time is being spent in carrying these cargoes, there you see that the growth rate is somewhere between 2.5 and 3.5%. If you look at the same thing for minor bulk trade, which is what we carry most of the times, then you can see that minor bulk trade has been growing at between 4 and 5% very steadily right throughout this period of time, whilst the supply side has been growing at about 3%. So we've always had a good cushion of demand growing faster than supply in the minor bulk trades. So this slide shows you the type of cargoes that we're carrying, and of these cargoes, agri products and coal, they are part of the major bulks. All the rest are part of the minor bulk cargoes. And you can see roughly we carry between 12 and 13 million tons per annum on our ships. Now coming to the supply side. So if you look at the supply side, and this is as of the 1st of November, so it's a pretty updated slide, you would see that the population size in deadweight ton terms had increased to about 869 million deadweight tons of ships, of which the smaller size is at 108, the smaller size, handy size, and the next size, the Supermax and Ultramax, is at about 204 million deadweight tons. Overall, you can see here on the right-hand side, lower column, that the overall growth this year in terms of supply has been almost 28 million deadweight tons, or about 3%. Now, this shows you what is balanced still to come. So in 2019, you still have another 10.6 million deadweight tons to come, or about 1.2%. In 2020, this is going up to about 51.7 million deadweight tons, or about 6%. And in 2021, it's 22 million tons, or 2.6%, and 2022, 2.9 million, or 0.3. So overall, we have got less than 90 million deadweight tons of the forward order book, or roughly 10.1% of the total supply side. Now, of this amount, the majority of the ships that are on order are the gearless variety or the bigger ships, ships that we are not, that where we don't have any play in that sector. And that is almost twice the growth rate of the sector in which we are participating. This slide gives you a relationship and establishes a relationship between GDP growth and billion ton mile growth rates. And there, if you do a regression analysis of these 19 years of data that we have, you would find that you will get a 98% fit. So it's almost a one-to-one correlation. We've also found that if you add 106 basis points over world GDP growth rates, you would arrive at the growth rates for ton mile growth rate. So there is a relationship there. That relationship is at the 52% mark. Now, if you look at the forward order book and compare it to the whole fleet that we have, you see that it's about 10%. If you then look at the 20-year-old fleet, which is there, you would see that they are roughly about 7%, but that is basis today, whilst the forward order book is all the way to 2022. So if you compare like for like, then there will be about 11% of older ships in the fleet, whilst 10% of new ships would be arriving. So more or less a replacement of the older ships. If you look at the same thing, just for the, that's for the whole fleet. If you look just for the handy size and the Supramax, then it is a much more interesting picture. Here you can see that the overall world fleet in the handy size is about 108 million tons. Forward order book is just 4.8 million tons, so roughly 4%. The current 20-year-olds in the handy size sector is 13%, and like for like, if you were to compare with 4%, it's 16%, so 4 times as much. This indicates to us that the handy size fleet is not being replaced, and that the cargoes which the handy sizes fleet is carrying will now start to be carried by the Supramax and the Ultramax fleet. If you look at the Supra and Ultramax fleet, you see that its total deadweight tons is 204 million tons. Forward order book is 14.3 million tons, or roughly 7% of the world fleet. The current 20-year-olds are 9%, and the forward position, if you were to extrapolate to 2022, is 13%. So again, here, it seems there is a weakness in the forward position of the supply. And remember, some of the cargoes carried by the smaller handy size ships will start to come into the bigger Supramax and Ultramax ships. So it should be resulting in a good, stronger market in the future. Trade wars and tariffs. I think we've said enough about this. Currently, it appears that a short-term deal or a preliminary deal would be signed shortly. That's the latest news that we've read. Again, one can't put too much reliance on that because Trump is extremely volatile and might change his mind tomorrow. And that's one of the reasons why China is trying to delay the signing of this contract as far as they can. Coming to regulatory changes, and this is important for us. There are 2 regulatory changes which are important: ballast water management and scrubbers, or the IMO 2020 Clean Oil Program. So I've listed out for you all the important regulations, but the main ones are highlighted for you here in the blue box. Now, what is IMO 20 and what is it all about? It's about reducing the emission of sulfur so it is about reducing the sulfur emissions from the exhaust of the ships. Now, if you look at the sulfur position in the past, from 2000 all the way to 2012, we were burning heavy fuel oil with a sulfur content of 4.5%. Then in 2012, this was dropped to 3.5%. And now in 2020, it's going to come down to 0.5%. In the meantime, there were special emission control areas, or very sensitive, environmentally very sensitive areas, where the United Nations had decided that at these emission control areas, the maximum sulfur that you could burn in the past was 1.5%, all the way from 2000 to 2010. Then it dropped down by 33% to 1%, and then it dropped down by 90% to 0.1% in 2015. So in the emission control areas, you can only burn 0.1% sulfur oil. In non-emission control areas, you have to burn maximum 0.5% sulfur oil now. And if you look at the trend line of these two things, you can see clearly that in the future, somewhere along here, we'll find that you'll have to have 0% sulfur fuel oil. So what does it mean for us as ship owners? You've got three options, literally. One is you can install a scrubber or an exhaust gas cleaning system. You could switch to a low sulfur option, just burn compliant oil. Or you could look at an LNG engine, but we've not even shown that here because LNG engines would mean that on a retrofit basis, it'll cost you about between $8 and $12 million. And it'll maybe mean that the ship will have to remain in the dry dock for almost 6 months' time by the time you change the engine. So not a real option at all. Now, this is what it looks like in terms of scrubbers uptake in dry bulk. So in the gearless sector, which we are not represented in, it's about 24% of ships have already fitted, are fitting, or will fit in the future, because it includes the order book also. And 76% will just burn compliant oil. If you look at the smaller sector, only 5% will be fitting scrubbers, whilst 95% will be burning compliant oil. And the reason for that is quite simple. Scrubbers are really high maintenance, very, very difficult to manage. People don't realize how much of effort goes into it. You need one engineer full-time just looking after the scrubber. And even after that, you'll still find lots of accidents taking place with the scrubber. There are a lot of operational issues. It does damage the environment, because what are you doing with a scrubber? You're basically removing air pollution and passing that pollution down into the ocean waters. So many ports have banned the use of open loop scrubbers in their port areas. It's like saying in an aircraft in the past, you had smoking zones and non-smoking zones. So you had maybe 10% of the seats as smoking zones and 90% of the seats as non-smoking, but the entire aircraft 100% smoked. So really banning the discharge of open loop scrubbers in your port is the same as having an aircraft with 10% of the seats as smoking and the rest as non-smoking. Not a really effective method. So we think that at some point in time, open loop scrubbers may be totally banned. In terms of efficacy, when they work, they're good. And when they don't work, they're terrible. And there are many times that they don't work, and Carnival Cruise Lines is a classical example of when they don't work and how many fines they've paid. To date, Carnival Cruise Lines has paid a total of $60 million in terms of fines. It's not just related to scrubbers, it's also related to their dumping of trash into the oceans. Now, here is a live example of a scrubber actually failing. And you can see what happens to when a scrubber fails. Just imagine this engine is at about 800 degrees Celsius temperature, whilst the water which is pouring down on is at 25 degrees Celsius. So you're going to have a lot of thermal stress in the engine, and it's going to make this engine and the ship unavailable for service for almost 2 or 3 months, till all the parts in the engine have been cleaned up and repaired. All the water which is coming in here will be contaminated with oil. That water has to then be further sent ashore for cleaning before you can use it again. And it costs a lot of money to do that. Not only that, you would find that for this type of a ship, you'd find that on this type of a ship where this accident has taken place, it took place on a 209,000-ton deadweight ship, which was only 3 years old. It took place maybe about 100 miles off Singapore while she was coming into Singapore. They had to send tugs, salvage tugs, to bring her into Singapore. Now they will charge a percentage of the value of what they have saved. So you'll spend a lot of money on that. Then you will have to repair the ship, and it'll take you a month of downtime. In the meantime, just imagine your customer. You're carrying his cargo, 210,000, 205,000 tons of iron ore from Brazil to China. Now, most companies today, everyone works on just in time. So maybe they have 1 month stock, but this delay is going to be much more than 1 month. So it is a big problem for the customers also. So this is another thing that and this is not the only one. This is one where we have a video showing it, because somebody in the ship took a video and it went viral. But this type of incidents has taken place on at least 6 different ships where a complete collapse has taken place. So scrubbers, as I said, are high maintenance. The efficacy is good when they work, but they fail many times. And when they fail, it can be a catastrophe. So coming to low sulfur fuel oil, that's what you will have to be burning. If you're burning low sulfur fuel oil, only question is whether the oil is available, and if so, at what cost. Now, there is further new regulations that are going to come in the future, where we will have to be heading towards a zero carbon footprint. Now, to get there, we have joined as a founder member of the coalition Getting to Zero. And this coalition has a target that by 2030 we should have at least one ship to demonstrate that it can do normal sea voyages without a carbon footprint. So that is the objective. And the question is that what fuel can you use to achieve that? And that's what we are working on as a coalition. And right now, as I've put down a lot of details here, you can read that. So it just shows you that the industry is trying to take steps to preempt what's going to happen in the future. These are regulations which are going to come, and we are trying to get ready for them. This tells you about the low sulfur fuel oil availability. Actually, I've just given you one page of this. There are at least 5 pages of this. There are almost every single oil company in the world has confirmed that they will be able to give you low sulfur fuel oil. In fact, in a place like Thailand, which is not a maritime center, you can get low sulfur fuel oil today. So what will IMO 2020 do? It will act as a catalyst for higher time charter earnings. And why will it do that? Because whoever takes a ship will try to reduce the additional cost of burning this low sulfur fuel oil, which is more expensive. And this can only be done by slowing the speed of the ship. If you slow the ship down by 1 knot speed, then you will save between 3 to 4 tons of oil per day. And if you do it by 2 knots, it will be about somewhere between 7 and 9 tons of oil per day of savings. Now, if you did that, you went from 12 knots down to 10 knots, you would actually reduce the supply side by 17%, even if your ship was steaming only for 200 days and was spending 165 days in port. So, and if you remember, okay, so that is one part. Second part is on the scrubbers. Remember, we have a fleet of at least 10% in the existing overall dry bulk fleet, which is greater than 20 years of age. And if you go back in time to 20 years ago, which is in the year 2000, you can see that up to 1999, the average price of oil per barrel was only 19.7 per barrel. And in fact, if any of you are old enough to remember the Asian crisis, then you know that during that period of time between 1998 and 2001, oil actually dipped to $10 a barrel, half that price. These are annual averages, so you can't make out that type of a dip here, but that's what happened. Now, after that, if you see, the average price of oil has been at $62 a barrel. And actually, in 2008, it spiked up to $147 a barrel. That's when people's minds got focused and said, now we need economical ships. So you see the first economical ships starting to come out in 2010, 11, 12, 13. So effectively, I'm saying that the ships that were built prior to 2000 were built in an era of very cheap oil. Those ships were designed for power and not for fuel economy. Ships thereafter were also designed for power and not for fuel economy. Though they are younger, they still consume a lot of oil. But the ships designed after 2009, they started to become more economical. So you have a lot of older ships which will not be able to compete in the market. Because as a customer, if you're going to burn this expensive oil, you need to reduce that cost. And ships that burn a lot of oil are not something that you would want to take. And here again, I'm just bringing this slide back up again to show you how a small change of 6% in the supply of ships by reducing the speed made the market go from 3,500 back to $13,000 a day in 2 months' time, such a short period of time. So if IMO 2020 results in a lot of ships having to go into slow steaming, then you will find that the supply side will tighten quite sharply. So the questions before the clients is as follows. Will you employ a scrubber-fitted ship knowing that accidents can take place, knowing that they can also pollute the oceans? 2, second option, employ ships which are burning compliant oil. Everything works with them. But will you employ ships which are over 20 years of age, which burn a lot of oil when oil prices have gone up? So maybe you will not employ the high fuel consumption ships. And then you will come down back to the economical ships and that are burning the least amount of oil. And there our Ultramaxes have done very well. They are really, really good ships. We have 8 of them. They burn very low amounts of oil and they will hopefully get us a good premium. Secondly, our fleet is young and therefore the average age is about 7 years, and therefore we should be able to get some sort of premiums because they will be burning less oil than the competing ships, and therefore clients will want to pay us a little bit more to take our ships. So to summarize, 2017, 18 and 19 taught us that supply-demand balance is close by. All you need is a small removal of demand or a small removal of ships and rates can go up and down quite substantially. We've also seen that in 2019 and 20, all the predictions are that demand will grow by at least 1 to 2% more than supply. The order book to existing fleet ratio is at about the lowest it has been in the last 20 years. 2020 could be a very interesting year if we get some reduction in supply through scrapping of very old ships, or that the older ships don't get employed. And if they don't get employed for half the time, say let's say 5% of the ships are not employed, that will tighten up the supply side substantially. Future environmental rules, as I said, getting to zero coalition, etc., all these things will impact your ability to order more new ships. Therefore, the forward order book is pretty small. The only 2 risks that you have, which I've highlighted in red, one is of course geopolitical risks, and the other is of course the use of tariffs by Trump, which is actually leading to a slowing down of world economies, not because cargoes are less, but people believe that this will create a recession and therefore they are acting on that. So what is our strategy? Our strategy is to wait for 2020 to arrive. If the rates go up as we expect them to, then we will lock in our ships on longer term contracts. This is a snapshot showing you the pressure shipping fleet, and you can see we are still 36 ships. Average age is 8 years, and you can see that the average size is now 44,000 tons. The forward order book. So here it shows you what are the total time charter rates. So the red line gives you the time charter rates average that we have already pre-booked. The green line here represents the total number of available days, and the orange line here represents the percentage of the total number of days that has already been pre-booked at this rate. And this yellow bar represents the number of days that have already been pre-booked in each of these years on really long-term contracts. And the box here on top gives you the value of the pre-booked contracts. In terms of market segmentation, for Q3, the Handysize outperformed the market by about 12.5%. The Supramaxes underperformed by about 28%, and the Ultramaxes underperformed by 14%. A large part of this can be answered by 2 simple things. One is that when the quarter changed and the rates started going up, some of our ships were already fixed at the low rates in Q2, and they continue to be at those low rates in Q3. That's one. Secondly, in Q3, we had to position a lot of ships coming into dry dock to prepare for IMO 2020 and get them ready. We need to basically subdivide the tanks, clean the tanks, and get them ready to take the low sulfur fuel oil. And that's one of the reasons why we have underperformed the index. Now, Gautam will take you through the financials of the company.
Thank you. Swadikap. So for the third quarter, we reported a net loss of 0.96 million, which is an improvement from the loss of 4.48 million in the previous quarter, although not as good as a performance as what we reported, 3.25 million profit that we reported in the same quarter last year. So the main driver of the loss was the lower average time charter income per day per ship, which was $9,617 per day for this quarter compared to $9,002 per day for the previous quarter, although quite below what it was in the same quarter last year, which was $11,239. The average ship running cost per day came in at $4,576 per day, substantially lower than the 4,934 figure in this last quarter, and even below what it was in the same quarter last year, which was 4,695. We had 3,312 operating days this quarter. Of this, we had about 137 days that were ships in dry dock, and then we had another 267 days, earning days of ships that were fixed on charters prior to the beginning of this quarter, so they were at low rates, and these were two other drivers of the lower average time charter earning per ship per day for this quarter. The gross profit margin this quarter was 53.78, an improvement from last quarter's 46.76. Net profit margin was negative 2.8%, although still an improvement from the negative 13.87% in the last quarter. So our cash and cash equivalents figure for this last quarter was 42.62 million, down a little bit from what it was at the end of last year. Advances to Sainty stood at 64 million. Sainty is whom we have arbitration against. Total assets stood at 830 million, down from 857 million. The decrease is due to depreciation. Long-term loans stood at 245 million, down from 278 million at the end of last year and about 260 million at the end of the second quarter. So we had about 9.5 million of regular repayments plus about 6 million of prepayments. Our debenture exposure, nominally speaking, stood at 180 million, which is, again, nominally up from 169 million. However, we have a cross-currency swap, and so the real exposure on the debentures is 154 million, so that remains constant. Total shareholders' equity stood at 383 million. Book value per share, 7.52 baht, down a little bit from the end of last year, which is 8.14. The total liabilities to equity ratio has remained fairly stable, so it's about 1.17. So our operating expenses for the first 9 months of the year, the total figure is 4775, which is more or less in line with our target for the year, which was 4750. And the drivers of that, the slight increase, was lube oils, insurance, There's a slightly higher expenses on dry dock and also miscellaneous expenses, which essentially are expenses related to the IMO 2020 regulation. So this chart shows the operating cost of PSL versus the industry average. According to the latest survey, our operating cost per day is about $700 below the industry average. Every $100 of operating cost contributes to $1 million in the bottom line. So this is a $7 million advantage that we have for our fleet as such. This chart shows the evolution of our fleet. So at the top row, it shows the average age. You will note that the average age was more or less in the 15 range until 2011, at which point of time we began our fleet renewal program, and the average age started to reduce quite substantially. It's about 8 now. The line below that shows the average deadweight of our fleet. So back in 1995, the average deadweight was 19,514. And then it was a slow increase. In 2010, it was 24,901. And then there was a fairly rapid increase as we started to take delivery of our Supramaxes and our Ultramaxes. So it's currently 44,000, which is where it's been now for some time. The line below that shows the time charter equivalent, average time charter equivalent earnings per day for our fleet. So back in 1995, it was 7,306, which was at that time considered to be quite a good rate. And then that declined, driven by the Asian financial crisis. So it came down to 4,800, and then there was a slight, I would say a gradual increase. China joined the WTO. That drove good, strong demand, and the average rate went up to 16,489 in 2008. Thereafter, there was, mainly due to supply issues, oversupply of ships. The order book at the time in 2008-9 was about 50% of the total fleet. So due to supply issues, the rate gradually went down. The trough was in 2015 and 16, when rates were as low as 6,200 or 6,400. And now again, we're starting to see an increase in rates, a gradual increase in rates. So our operating cost has remained fairly stable throughout the years. So there was a slight gradual increase in line with industry, I would say lower than industry. 2009 is when it peaked. The average age of our fleet as well at the time was quite high, which is why then we went for the fleet renewal program, and then ever since then it's been fairly stable. This chart shows our total debt over time as well as the debt to equity ratio. So when we started out, we were in the 90s, when we were expanding, our debt went up a bit, the debt to equity ratio went up as well. Our strategy is to pay down debt as soon as possible, as whatever practicable, which is what we did from 1997 to 2003. And then we acquired a fleet, the MISC fleet, and so debt went up again. But then we capitalized on that quite well, and we paid down debt again. It came down to 0 in 2007 and 8. And then we embarked on our fleet renewal program, which is when we started to take more debt. And so the debt peaked in 2016, it was 482 million. And now it's gradually down. It's down to 400 in total, thereabouts. So this is, it says debt to EBITDA. It's actually total liabilities to EBITDA. It doesn't take into account the cash that we have on our balance sheet. This ratio has moved in line with our debt figure. It peaked in 2016 when earnings were particularly low. Also, we had a lot of ships, new ships delivering at the time. But ever since then, the market has improved, and so that debt to total liabilities to EBITDA, if you will, has declined. This chart shows cash operating P&L as well as the operating P&L. You will note that our cash operating P&L figure has, over time, over history, has remained fairly healthy. It's generally been quite positive, except for 2 years in 2015 and 16 when it dipped below zero. The operating P&L, which takes into account depreciation as well, of course, that is, there are a few more times, or not many, when it has dipped below zero. This shows the net profit as well as the cash profit, so the evolution over time. We've been quite profitable most years. 2015, 16, due to, as I said, due to supply side issues, were unprofitable, but we are gradually, either at close to break even or slight profit or slight loss, I guess, in the recent past. Cash profit, on the other hand, when you add back depreciation, cash profit is definitely a much healthier figure. This slide shows the dividends that we have given to our investors over time. Our policy is to give 25% or not less than 25% of net profit. And other than over the last few years, we've consistently been giving dividends to investors. And it's certainly our intention to start paying dividends soon again, as soon as practicable. Okay, so this is just a summary of our financial profile. 2014, 15, cash equivalents in 15 was 12 million, but it's gone up to a more healthy level. It's a level we are more comfortable with now, so we're about 42 million. Net debt, so after taking into account cash and the cross-currency swap, is about 357 million. So down quite a bit from our 2017 figure, where it was 412 million. Our equity position also remains quite healthy. It's 383 million. Net debt to equity as well, gradually moving down. So it's moving in the right direction. So it's currently at 0.93%. Total number of ships that we have remains more or less the same. So it's 36 over the last few years. So the total liabilities to EBITDA ratio is, at least from 15 and 16, it has down substantially. So these are some of the awards or award nominations that the company has received over the last few years. So PSL was nominated for Ship Owner of the Year by Sea Trades, Lloyd's List, and International Bulk Journal last year. Similarly, our ship management subsidiary Great Circle was nominated for Ship Manager of the Year by Sea Trade and Lloyd's List. And also one of our ships, our cement carrier Pinya Nari, was a finalist for Bulk Ship of the Year last year. These are again some more awards that we've received over time. So most recently, the PSL board was among 10 finalists for Board of the Year. This is an award instituted by the Thai Institute of Directors and the Stock Exchange of Thailand. And this is in the category of companies with a market cap below 30,000 million baht. Some slides on corporate governance. So slide 58 here. So this, quite recently, we were, again, for the 10th year in a row, we were classified as a listed company with excellent corporate governance, of 5-star corporate governance. It's something we're quite proud of. Also in August 2019, we were certified as a member of the private sector collective action against corruption. This is a ranking by Marine Money. Marine Money is a New York-based shipping publication, shipping finance publication, and what it does is it ranks shipping companies globally across sectors by financial performance. In its most recent ranking, which was published, I believe, in June, we were ranked number 16 out of about 97 listed shipping companies globally in terms of financial performance. And if you look within the dry bulk sector, so there are 19 dry bulk companies that are listed and are ranked for this particular purpose. We were ranked number 2 in terms of overall financial performance. So being a top performing, as far as financially at least, top performing shipping company is something that we are familiar with. It's from 2005 to 2012. We were consistently ranked among the top 10 shipping companies globally in terms of financial performance. This chart shows the total return to shareholders from 1993 to 2019. An investor who had invested at our IPO in 1993, if they had invested 85 baht, they would have received a net cash return which is 11.25 times what their original investment. Again, this chart shows a similar message in a different way. So if one had invested 1,000 baht in 1993 at the IPO, the value of the investment would be 12,247. Similarly, if one had invested 1,000 baht in 1995, that would be what, 3,414. In 2000, if they had invested 1,000 baht, that would be what, 51,300. Similarly, 2005 it would be 1195. 2010 and 15, market's been weak, so that return is not as positive, but still. Thank you.
There are some questions from the net. Whilst the floor is getting ready for questions, we can quickly answer. The question on the net is that why we have seen that the BSI is weaker than the BDI rate. What is the underlying reason for this picture? The BDI has a 40% weightage towards the Capesize sector, 30% weightage to the Panamax sector, and only 30% weightage to the Supramax sector. And therefore, of course, the BDI outperforms the Supramax sector if the gearless ships do well. And that's what's been happening so far. So that's the reason for that. The next question is, why is PSL Supramax rate below the market by 28.5%? I think Gautam answered that question by saying that we had a lot of ships which were already employed in quarter 2 for almost 259 days, which were already employed at a lower rate from quarter 2, and that continued into quarter 3. Similarly, we had about 137 days of downtime in quarter 3 for dry docks. And then post the dry docks, we had a couple of ships which were sent back to the Atlantic at a lower rate. So all these reasons have compounded and come together to make our performance under the index level. That's the first thing. Second thing, please keep in mind the average size of the Supramax ship in the index is 58,000, and our average size is 53,000. So we have at least a good 10% deadweight reduction compared to the index ship. So we should always be underperforming the index, and we've got independent third parties to actually check what should be our rating compared to the index ship, and they say that somewhere between 15 and 20% below the index. So when we underperform like this, it's not a big underperformance. And when we do perform at the index or above the index, It's a great outperformance. The third question is that will our Supermaxes in the fourth quarter get the same level as in the third quarter? Unfortunately, we don't make forward-looking statements, so I really can't guide on that answer. On the third question, it's in Thai, but I have the translation here. They've asked for a summary of the market outlook and PSL outlook for 2020. Again, as I said, we don't give forward-looking statements on PSL, so I can't really say much about that. But in terms of the market outlook, it looks very bright. I mean, as I've explained in the charts, all you need is a slight contraction in the supply of ships to create a spike in the freight rates. And we have seen that happen this year in spectacular fashion because of the Vale mining disaster and the two storms in Australia coinciding at the same time, bringing the rates for the Cape-size ships down from 13,300 down to 3,400 in 2 months' time. And then the owners taking action by scrapping more ships, reducing the supply of ships by slowing them down just by 6%. And we saw that made the rates go back up in the next 2 months back to the original levels. And then when the Vale mining disaster all the mines that were shut down, one of them started to operate again. More cargo came into the market and the rates went up from $13,300 to $38,000. Of course, at that time, ship owners got greedy and they started to increase the speed of ships because they want to earn more money during that period of time. As a result, they created more supply. And when they did that, the rates started to come down. So that's the story. Now, all the mines in Brazil have not yet restarted. 2 mines have restarted. All the rest are still to restart. So you still have about 50 million tons of capacity of supply of iron ore from which would have taken place during the year 100 million tons. Only about 50 million tons of that is now restarted. So another 50 million tons is still shut down by the courts in Brazil. So these are the reasons why the market has been fluctuating as it has. And we think, therefore, that in 2020, with IMO 2020 and low sulfur fuel oil coming into play, costing more money to buy because it's a cleaner product, it will make sure that all ships will be slowed down. And when that happens, that should be really good for freight rates. So we think that the outlook for 2020 is quite bright. Now, there are no further questions from the net, so we'd be happy. Want to sit.
Thank you. I just want to ask about the dry dock. Given that we have an average fleet age of 8 years, do all of our ships need to be dry docked in preparation for IMO 2020? And what is our dry dock situation looking like for Q4?
For Q4, we have another 4 ships which are scheduled for dry dock. So yes, it will result in some more downtime. Almost similar level as Q3. And similarly in Q1, we will have also about 4 ships. That will take care of the full dry dock for IMO 2020. Rough amount of days downtime will be about this 130, 140 days for each quarter. This quarter coming and the next quarter.
I understand that in preparation for the IMO, other shipping companies will also need to install scrubbers or do the dry docking. But given the supply reduction before the IMO, why are we seeing the downtrend in the BDI lately?
See, like right now, there is no reduction in supply at this moment. In fact, there is an increase in supply because ships are going faster. Rates are high. People are going faster. So actually you have more supply of ships. Scrapping has come down to 0. If you see the scrapping slide that I have, it shows very low scrapping for Q3 and Q4. And in the smaller sectors, actually virtually 0 scrapping. So there is a lack of removal of supply from the market. So supply is still strong. People are still waiting and hoping that maybe they will earn some money before the IMO 2020 comes in. So that's the reason why. We expect Q1 will also be a little bit like that, and then you will see the results of the slowing down of ships and scrapping of ships. That'll come up. Towards the end of Q1, you will see the full impact of that.
Given the incident with the scrubber that you shared the video, are we seeing a significantly less installation for the scrubbers in the market?
In fact, in the tanker sector, the tanker market in 1 week's time went from $30,000 a day to $330,000 a day. From $30,000 to $330,000 a day for VLCCs in 1 week's time. As a result, even VLCCs which were waiting in line to get into dry dock for scrubber fitting, they actually moved out. They said, let us take advantage of the high market that is there now. Of course, since then the market has come down. So it's not come down to $30,000 level, but it's come down to about the $70,000, $80,000 level per day. But still, it's a lot of money. So tankers are delaying putting the scrubbers on right now. I'm talking the very big tankers, VLCCs. Okay, so we have another question from the net. What is the reason behind BDI declining during the last 1 to 2 weeks? It's very clear. If you see that slide that I've shown you about how supply changes, makes a big difference. So if you'd like to imagine a balance which is in perfect alignment, all you need is a small increase in supply to make the price go down significantly, or you need a small increase in demand for the price to go up significantly. So right now what we are seeing is because of the increase in speed, all the ships, you're creating more supply, and that is what is resulting in the rates coming down. Sure. See, if you look at this slide, it gives you the answer. This slide gives you the answer. See, less than 5% in our sector are fitting scrubbers. Nobody really wants them. These are only the American listed companies that are doing this. Because for whatever reason, in America, the analysts and the investor relations officers of all these companies believe that this is the best thing since apple pie. And therefore, this will make them a lot of money. So they're all focusing on this, which is the wrong thing to focus on. And in fact, if you look at any of the sensible owners, and especially Asian owners, none of them are fitting this. Scrubbers is bad technology. It's good on land. It's very bad at sea, because the ship is not a stable land-based type of thing. But scrubbers have been in use for the last 70 years, but only on land. Now you're trying to apply a land-based solution to something on a ship. And it's not necessary that it will work, as I showed you the catastrophic failure that took place. So clients have to think about this. Now, of course, what do clients do? They always shop around. They'll shop around, get the lowest possible rate, and then tell you, hey, listen, we can get this rate. Are you interested in the business? And we turn around and tell them, no, we're not interested in the business. You can go and fix with them. And if they really want a quality owner and a quality ship, and if all this lip service that they give to that we are environmentally friendly and we want to make sure that the environment is safe, then we know the truth of that. They're all interested in the last 5 cents that they can shave off the rate. That's what they try to do. But the bigger clients, they all are happy to pay you a little bit more. So it is differentiation is there with the good clients and the poorer quality clients. You can see that.
In regards to the dry docking of the ships in third quarter and fourth quarter, is it possible to get an estimate of the capex per ship that's required for ensuring it's IMO 2020?
We don't have much of expenses to actually. It's a normal dry dock for us, except that we are going to maybe add we'll subdivide some tanks. doesn't cost that much more, a little bit more. So like if you see the miscellaneous cost has gone up to double from $60 odd to about $100 odd. So that's what is the extra cost, but not too much. And it's a one-time thing. After that, it'll be gone. And I think we're run out of time now. They're signaling that no more questions. Maybe we can chat outside. Anyway, thank you so much. สวัสดีครับ
ขอบคุณค่ะ